So, Samanjit, all of you here to me. We had a deal before you have come. Anybody, to opening the video means I'll have to close the recording. If people are not opening the video, we'll close the recording. Other things will go on as it is. Could you get it, Samanjit? So you see your friends have done a deal with me before you have come. Okay. Good afternoon, everybody.
Good afternoon, sir.
Good afternoon, sir.
Good afternoon, sir.
Somebody is writing, I am having fever, sir. Can I switch up for this class? Do as you like. Somebody should come forward and summarize whatever we have discussed in the last class.
Recording in progress.
We have discussed about the short-term loan, long-term loan, and the cash conversion.
So Ashish, you will be
Yes, sir.
you will be summarizing as if you are teaching the class. In 5 minutes, we'll tell everything, or 3 minutes, we'll tell everything. Don't tell that only the terms that we discuss this, that, like that. The way I have taught you, in brief, you tell me. Logic behind it, why you are doing, how did you progress, how you build up the subject one after other. Come on.
So basically the short-term loan which we are taking for a certain period for a 1 year, so that we are considered as a short-term loan. So there are many benefits are there, like there are more interest in short term, and in long term those are the loan we are taking for long period, more than the 1 years, that we can say that is a long term loans. And we discussed about the cash conversation, time and amount graph. We discussed about these things also. Sometimes which one is aggressive, which one is moderate, which one is less aggressive. So these are the things we have discussed. And one more thing, the cash conversion cycle also we have discussed.
Tell in detail.
Details.
Okay, fine, Ashish, fine. Abhik, tell.
Yes, sir. Good afternoon, sir. So we further discuss about the different balance sheet ratios, such as current ratio, which is current asset by current liability, then inventory turnover ratio, which is cost of goods sold by average inventory. Next is receivables turnover ratio, which is credit sales by average inventory. We further discussed about assets turnover ratio, raw material conversion period, work in progress conversion period, finished goods conversion period, receivables conversion period. All these things we discussed. By adding up all of these things, we get the cash conversion cycle, sir.
Okay. But the basic concepts I could not get. Okay, I am explaining again. So try to next class you try to explain the way I am telling now. Ask your friends not to join so late. I am getting disturbed. Okay, fine. Let me share the screen with you. You tell me whether I have missed anything or I'm telling anything extra. So first we discuss the current assets and current. Are you able to see the screen?
Yes, sir.
Yes, sir.
So we discussed that. You see, in the previous class in the first class we have discussed about the profitability and then statement of profit and loss, balance sheet. Then segregated the figures in the balance sheet as non-current assets, non-current liability, non-current assets, current assets, non-current liability, current liability. Then we discussed the working capital primarily focus on current assets and current liabilities. Okay. So current assets and current liabilities are the components of working capital. Then we discussed that what are the tools or parameters that will define how nicely we are managing our working capital. So some of you told that current ratio is one among the major ratio which explains how nicely you are managing your working capital. So current ratio is current assets by current liabilities. So then when we discussed this thing, somebody again suggested that 2:1 is the ideal current ratio. Then we went into the individual items, found out how your current assets need not be high because receivable you expect to be low. Inventory you expect to be low. You don't want to keep your huge cash balance with yourself. Are you getting me? So, and again liability you want to maintain at optimum level so that you don't have a bad picture in the society, in business environment. And so also too less also means you are not availing the opportunity from outside. So looking into all those things, you cannot define what is the norm for current asset, current ratio. So 2:1 is not a right kind of, it is a sacrosanct ratio that okay, we fix this ratio, we will have to achieve it anyway. No. So you will have to look into individual items and then find out how you can minimize the fund involved in each area. So when we are talking of individual items, then we proceed into the way we are looking into, sorry, first we discussed about the way we are discussing the current ratio. If it is a management perspective, they will try to reduce it less than 1. But in a banker perspective, what do? The banker sees that if you have a requirement, they will give you a short-term loan. So when they can decide how they can decide the requirement of an organization, they will have to see that your requirement for receivable and inventory is high. If it is high, ratio will be naturally more than 1. Did you get it? Did I discuss this thing?
Yes, sir.
Yes, sir.
Okay. Okay. Then I told you, I suggested that okay, many good companies in India, their ratios are less than 1. It is partly true because I checked the figures again. Now you see, due to Corona or whatever it is, in recent times, I found that it is hovering around 1. Hovering, you understand, little bit higher or little bit lower. Like Colgate Palmolive was lower, Tata Steel was lower, your Hindustan Unilever was little bit higher, ITC is quite high. So no established norm is there how to determine how much should be your current ratio. Okay, but
Sir, but ideal, he said
hovering
that
around
2:1,
1, now you see, again you are telling I have 2:1 ideal. I told you, again you are telling the same thing. Who is telling? Hello? Who was telling 2:1?
Bhaskar, sir.
Divyajyoti? Bhaskar.
Yes, yes, sir.
Bhaskar, tell
Divyajyoti,
what you
sir.
are telling. What you are telling? Tell again. Tell. Bhaskar,
Sir, yes, sir, yes, sir.
tell.
I was telling that, sir, actually I read somewhere and
You have read many things I don't know, but what I am
yes,
telling
sir.
you here, I am giving you the logic. Finance is not a subject which is established on something which is doesn't have a base. So you tell me, your figures, your reality, what you are seeing in the balance sheet is more appropriate, or you have read something that you will have to follow. Tell Bhaskar. We discussed step by step, one by one each item. When you told that current assets should go down, it should be lesser. So if it is lesser, naturally it cannot be 2:1. If you very high a current assets, then only it will be 2:1. Again I am telling you, I checked the figures in many balance sheets. It is hovering around 1. Little bit lower than 1 or little bit higher than 1. I was telling you beforehand that it may be much lesser than 1. Maybe very
Sir,
few companies are there. Yes, tell.
sir, but previous teacher taught us that 2:1 is the ideal ratio. We have to maintain that ratio.
So you follow him,
Yes.
okay? You follow.
No, sir, I am following you, but
No, no, I am telling you a logic why you are citing what teacher has told. I told you management education is always supported by logic, reality, what is happening in the
yes, sir.
world. I
Now
told you I
understood.
checked the ratios. I found out like this. Colgate Palmolive 0.8, Hindustan Unilever 1.28. I told it beforehand also it will be less than 1. But many of the companies I found are not able to maintain lesser than 1. But if it is comes down less than 1, it is good. Because you are managing its full less current ratio. I told you individually item wise. Again, how you are citing the same thing. Bhaskar, I don't understand. All of you are getting me, what I am telling.
Yes, sir.
Yes,
Correct?
sir.
I am giving you a logic. And you
Yes,
are
sir.
again जो बोलता है ना मुझको घूम घूम के जो जानवर लोग को ये करते हैं ऐसे तुम उसी को फिर twist one. I gave you the logic why it is like this. Reality I am telling you many companies are offering around 1. Good companies. Are you getting me, Bhaskar?
Yes, sir, understood, sir.
Make
Sir,
your
many
mind.
companies are, sir, hovering around that. Now I will discuss
Good
that.
companies.
You
I
will
am
tell
telling
me
you
that.
good
Yes, sir.
companies. We are talking of norms. I am not talking of. I
Sir,
am not
but we
talking
should
of
talk about good data, sir, too, sir.
what you are telling. Ideal means what do you mean? Bhaskar,
Ideal
what do you
means,
mean by ideal? Ideal means what we are trying to achieve.
yes, sir.
What we are trying to achieve? We are trying to achieve lesser current asset. Simple. What is the confusion? I don't understand. It is so simple. In reality, there are companies. You see, I checked the figures. ITC is much higher than 1:1. It may happen. I'm not telling that in reality some companies may be having 4:1. So does it mean that that is the norm? So I told you there is no norm. You will have to go to individual ratios and then you find out which ratio is appropriate. I don't want to cite on other teacher has told, I've read in books, all those things are not important to me. I am giving you a
Sorry,
logic.
sir.
If you accept, it's fine. If you don't accept, keep quiet. Don't tell all other students, sir, that it should be like this and it should be something different. If you are not convinced, you question me. That you see, it can be like this. How you are telling like this? Then you can question me. That's fine. But I am giving you a logic. I have read somewhere or teacher has told. Doesn't make any sense. Others are getting me what I am trying to say.
Yes, sir.
Yes, sir.
Yes, sir.
I am telling you, I am giving you a logic. You don't agree, counter me. I am ready. I will try to prove. If I am wrong, I will tell, yes, okay, I have taken it wrong. You see, last class I was telling it will be so much lesser than 1 is good and ideally many good companies are lesser than 1. Now I found no. Now some few companies are little bit higher, some few companies are little bit lower. So then I corrected myself. But ideally what we will try to do, lesser the current asset, better it is. But for your banking perspective, I have told you that bankers will like to see that if you have higher current assets, they have got a necessity to finance you. That's why they will see that your current assets should be higher. Are you getting me? Could you get it?
Yes, sir.
Rahul? Rahul Kumar Pathak?
Yes, sir.
Could you get me what I told?
Yes, sir.
Can you repeat?
But he has switched off his camera, sir.
Sir, I have a network issue, that's why I have switched off.
But then I'll have to stop recording.
No, sir, I am switching on.
That
Sir.
was the condition.
No, sir, I am switching on.
Tell.
We are just talking about the bankers, the current asset, look higher the current assets, sir.
Why they are looking for higher current assets?
Uh,
Dipsika?
so that can they can manage their expense.
Rahul, second semester MBA. Listen to me properly. Dipsika,
Sorry, sir.
Yes, sir.
tell why bankers will look for higher current assets, current ratio? So sad. Arpan Mohanty, Anuradha, are you there? Nirbek, Rishabh, Jen,
Yes, sir.
tell.
So to check if there are any other liabilities.
Itisri, tell.
Sir, to provide financial support.
Okay, they will provide finance support, but why it should be high? Why bankers will look for higher current ratio? Divyajyoti,
Yes, sir, for providing loans, banks check if the person is eligible to pay or not. If he is carrying
no,
some,
not the eligibility of paying, eligibility of requirement. Aliva,
yes,
tell.
Yes, sir. So the bankers will look if there is a higher current assets than the current liabilities, then they will fund the company so that they can supply with
They
so
will
that
come to
they
a
can
conclusion that the company has a requirement
yes,
because a higher amount of money is involved. Simple thing. Why all of you are not able to answer, not listening at all? You don't understand something, you ask me. Don't do like this. I will be keeping on asking, you will be keeping mum. Okay, good, Liva. So could you get it? So if your current assets and inventory is high, then this figure justifies that you have a requirement. That's why they look for say 2:1 is the ideal ratio they will be looking for. But for a management perspective, you will like to reduce as much as possible. Then we discuss about the individual ratios like inventory turnover ratio, receivable turnover ratio, payable turnover ratio, asset turnover ratio, and working capital turnover ratio. All those ratios are explained in terms of times. Higher the ratio, better it is. Correct. So here you can describe something as ideal because it is one side movement. So you can tell say inventory turnover you are telling 6 times. It's fine. A good company may be having lesser than 6, more than 6. Receivable turnover ratio say 4 you are telling. It should be more than 4 if it is better. So like that, all those things can have norms. But current ratio is a subjective ratio or broader ratio which cannot be defined so easily. Because so many items are involved, individual item you have to manage, then only you can tell whether it should be high or low. Requirement wise also you will have to say better, higher is better or lower is better. Okay? Then we discuss about the working capital policy. So to finance your working capital requirement, you may use long-term fund or you may use short-term fund. So when you use more long-term fund than your requirement, it is a conservative company. When you use lower long-term fund than the requirement, it is aggressive. In between, it will be moderate. Okay, so here what is the trade-off? If you are using more short-term funds, you are managing the disruption of production, higher interest rate or uncertainty. Why? Because every time you will have to run for your working capital requirement. And there is a possibility that you may not get the fund, your production may hamper. But if you manage properly with a lot of challenges and uncertainty, you can manage, your total interest cost may be low, giving you higher profitability. Could you get it? We have discussed in the last class. Then we told that there are two approaches how you approach the working capital. One is through ratios, another the process we are discussing. You see, ratios and other things are extracted from balance sheet. Balance sheet is prepared on a specific date. So on the last day of the year, the figures show the figures that is used in ratios comes out from the last day of the balance sheet. But when we are talking of the requirement of working capital, it is from beginning of the year to the end of the year. So through this beginning and end of a year, you have got a production process. That production process involves the working capital requirement. So we divided the working capital requirement into process into 4 parts. One is we purchase the raw material, then raw material was kept in the inventory, that is raw material conversion period. Then it went to the production process, it is work in progress conversion period. Then it went to the finished goods stage, is finished goods conversion period. Thereafter it went to the receivable conversion period. Okay. So like that, the whole process is managed from beginning to end. So then we discussed that this process may not be 1 year. It may be lesser than 1 year, it may be more than 1 year. Companies are equal to real estate companies, manufacturing, equipment manufacturing companies, they are having a conversion period more than 1 year. Why? Because you see, from the beginning of introducing money in the raw material to the end of getting the product and getting the money, it may extend to 5 years, 4 5 years time. So it is much more than 1 year. Whereas if it is a FMCG company or a company, a consumer durable company, your requirement will be, your working capital cycle will be lesser than 1 year. So shorter the working capital cycle, better it is. Cash conversion cycle should be shorter, it should not be higher. Correct? We have discussed these things. Tell yes or no.
Yes, sir.
Yes, sir.
So then the formula we discussed: raw material conversion period, raw material inventory by raw material consumption multiplied by 360, WIP conversion period, WIP inventory by cost of production multiplied by 360, finished goods inventory by cost of sales multiplied by 360, receivable conversion period, trade receivable by sales into 360, payment deferral period, trade payable by cost of goods sold into 360, and you add up everything. You see, everywhere in all those conversion periods, like your raw material conversion, WIP conversion, inventory conversion, and receivable conversion period, your money is getting blocked. It is diseconomies. Diseconomy means it is a disadvantage to you in terms of interest. But other way around, what you are doing, all those materials that you are purchasing in the process, you are taking it credit from the supplier, they are getting an advantage. True or not? In supplier's money you are managing the business. So that's why that period, which is payment deferral period, you deduct it from the conversion, then you get the cash conversion cycle. Up to this level we have studied. 4 or 5 students who confirm, then I will proceed further.
Yes, sir.
Yes, sir.
Yes, sir.
Okay?
Sir,
Ask.
sir, I have a question regarding sir balance sheet. May I ask?
Yes, you ask.
Sir, when I looking at the balance sheet of any company, I look, sir, in asset side it was given income tax, sir.
Deferred tax. Deferred tax and income tax.
Income tax, sir.
You see, in balance sheet you
paid
have...
for advance for the next year.
No, you see, you have got 3 items in the balance sheet. I am telling you, 3 items, possible items in the balance sheet. One is deferred tax liability, another is deferred tax asset, another is advance tax, another is provision for tax. These 4 figures will be there in the balance sheet. No other figure is possible. Tell, which figure you are talking of?
Sir, I saw income tax, sir.
Only income tax.
Yes, sir.
Which
income
section?
tax
Which
in
section?
asset side, sir.
Asset side, it can be either advance tax or it will be deferred tax asset. Okay. Advance. So it may be like that. Your heading will be advances, then different kinds of advances. In that you may be having income tax. Okay. So either it will be okay. But deferred tax asset liability is again complex concept. To explain it, I'll have to take one class because I don't have time. I cannot explain now. You get me? Advance tax, when you are paying in advance, it is an asset for you. Why? If you don't pay, you pay later on. What is it? It is a liability. But you paid in advance, it is asset for you. So that's why it will be shown in the current asset. But when you are putting it in liability side, it is a provision for tax, you will be putting in the current liability. Okay? So till now we have discussed quickly what you do. Now this balance is with you. I have sent you this Hindustan Unilever's income statement of profit and loss and balance sheet. Here your figures are there. I have organized it for a purpose of our convenience. You have to look into the working capital requirement. So what you do, calculate the current ratio first. It is easy. Quickly you calculate. For the year 2021 we have calculated. You have the figures with you, everybody? Tell.
Yes, sir.
I have sent in Google Classroom.
So
Quickly.
1.28. Yes, sir.
1.28. Okay. Somebody has done it. Let us do it now. So I write here. So equal to current. That is what are the figures for current asset?
So 14,217. 14,217.
Right here. I write here. Current assets by current liability. Current asset by current liability. Current asset is 1314 plus 442 plus 1927. Sorry. 1607 plus 216 plus 1758 plus 2707 plus 1702. So all those are current assets. Current liability is how much? 8806.
11,100.
Let me write down the figures. Few people may not be getting it. 365, 1357 plus 7. Where's the figure? 1 4.
11049.
What is the current asset?
14217.
14217.
This is
1110.
11049.
one at a time.
11049.
How much it is?
1.29.
29. Okay. Bhaskar,
It is
103, sir.
11,103.
this is 1103. Which one?
Current liabilities.
Current liabilities.
11049.
1110.
11,103.
Okay. Bhaskar,
Yes, sir.
Hindustan Unilever is a good company or bad company?
Very good.
Very good company. So whatever ratio is coming in this balance sheet, we can tell it is a good ratio.
Yes, sir.
How much it is?
So that is 1.28.
So again you will argue further. 2:1 is ideal, sir. We have
Oh, sir,
studied
sorry regarding
book.
that, sir.
No, you don't feel sorry. What I'm telling you, the way you see things, you change it. Whatever you are finding from reality, from logic, that you will have to accept. Because you say last class I was telling much lesser than one. Now why I changed my view? Because I found many companies due to COVID or other things, their current ratio has changed. Because I would have taught in the last year, so that knowledge I was carrying. Could you get me? So 1.29 is hovering around 1, I am telling you. Little bit lesser or little bit more in that area, it is hovering. Correct? All could get it?
Yes, sir.
Ashish Kumar Paik Rai?
Yes, sir.
Ashish? Abhik is there. Bhaskar is there.
Yes, sir, got it,
Chandita?
sir.
Yes, sir.
No, Chandita?
Yes, sir.
Chandita, are you getting what I am telling?
Yes, sir.
Which company is this one?
Sir, HUL.
HUL. Ratio is good or bad? Should be good or bad because you know HUL is a very bad company.
Sir, HUL is good.
HUL is a good company. Okay. So its ratio you can tell if it is ratio. Disconnected. Why? What's happened? Okay, fine. Okay. So in a good company we are getting a ratio like this. Okay. Okay. Now next is we have calculated the ratio of
current ratio, sir.
Current ratio we have calculated. Can I clean it now?
Yes, sir.
We can calculate current asset by just decreasing such non-current asset from the total liabilities.
That you can do. Correct. True. So, you see, why I am adding up those things, what happens in reality, we took all the figures. Sometimes what happens, few things are divided, you see, I have reorganized for your purpose. But how they will write, suppose they are writing investment. In investment, there will be two categories, long-term investment, short-term investment. Then what you will have to do? You will have to take the short-term investment. Okay? So that's why I put it individually so that people can know which figures are coming. You can do in the reverse way also, total assets minus non-current assets. Non-current assets also many items are there. I have clubbed it up for your convenience because it is not required. You will be confused with so many items. Okay. Then next ratio is, quickly,
Inventory turnover ratio.
Inventory turnover ratio.
where is the formula?
Cost of goods sold, cost of goods sold by
Cost
average.
of goods sold by average inventory, sir.
Okay. So, again you see, here when we are defining cost of goods sold, how we are explaining. Cost of goods sold. That means we are selling something, its cost. True or not?
Yes,
Well,
sir.
so something you are selling, what is its cost? Average inventory. First remember, when we are talking of COGS, we are talking of a cost accounting concept. Okay. The cost accounting concept is primarily focused on operational efficiency. What is the other efficiency? I have told you in the first class. Forgot? Financial efficiency. In financial efficiency, we will have to see how do we manage your interest, how do we manage your tax, how do you manage your dividend. These are financial efficiency. Operational efficiency means you will have to consider all those costs involved. So cost means it will be in a PL account or balance sheet?
PL account, sir.
PL account. So income and cost will be in PL, assets and liabilities will be assets, so we will go to the PL account. So in PL account, what we will have to find out? Something which relates to your operational efficiency. What are they? They are
Cost of material consumed.
all those costs except your interest, tax and dividend, because that is operational efficiency we will have to consider. Again you see, cost of, so tell me whether cost of material consumed will include or not?
Yes, sir.
Yes, sir.
Tell me the figure. You see, I am including the figures, all figures, because that way you can know it better. You see, you must have read those things beforehand, but what I am telling you, I am trying to put the management perspective. Management students should not read it just like your BCom and I+2 students. They should see how you put the figures, why you are putting the figures. All those things you should question. Then only your knowledge will be refined and you can work in the organization, apply the figures. Remember, whatever you are studying in the book, the work is totally different. Only what helps, the way you apply your logic. Okay? Bhaskar getting?
Yes, sir.
Yes. So tell Bhaskar, then what I will do, cost of material consumed will, so we are doing it like this, COGS divided by average inventory. So
We
tell
will
me,
calculate, sir, cost of goods sold. That will be.
you tell me, cost of, you step by step, you learn the things. What are the things we are
Yes, sir.
including? So we are
We
telling
will
all
include,
those,
sir, raw
all
material.
those operating expenses will include one by one, don't be hurry. Cost of material consumed will include or not?
Yes, sir.
Yes, sir.
How much is the figure?
22,255.
Yes, sir. 553.
Then changes inventory work WIP
Yes,
will
sir.
include or not?
We will decrease, sir.
Yes, sir. We will have to
Less, sir.
subtract it, sir.
405. This is a negative figure if you put in parentheses. Okay.
Then, sir,
Then
we will add 2358 employee benefit expenses.
4358.
That,
Finance cost will
again,
exclude, will not consider.
no, sir, we will won't consider, sir.
We will avoid. Then depreciation amortization.
Yes, sir, 2358.
Because you
Sorry,
see, anything
1073.
which is 1 minute, anything which is contributing to the cost will include. So depreciation is also contributing to the cost, because if your machine is not working, how product will be produced? Raw material will be converted to product through the use of machinery, use of employees. True or not? So 1074. Then tell me other expenses we should include
Sir,
or not?
70%
Sir,
of
sir,
10 at
depreciation
96, sir.
and amortization will be the will minus, no sir, minus 1075. Will deduct,
Why?
sir, depreciation.
It's the cost now we are adding it.
It is a cost.
These are the expenses.
Expense we are adding.
Okay, okay, sir. Yes, yes, please.
Sir, why finance cost is not included?
I explained you just now. Operational efficiency, financial efficiency.
Okay, sir.
COGS is a concept which is involved with operational efficiency, so finance expenses will not include. All could get it or not? Why we are not including finance expense?
Yes.
Because
Sir,
you see,
employee benefit expenses, how is it directly related to the operation, sir?
you tell me, suppose your raw material is here, product is here. Raw material straight away will be converted to product. Workers will be engaged to process it. So are not they contributing to the product cost?
Achha, these are the direct wages, right?
Direct, indirect, don't put it like that. There may be further classification also. Here from employee benefit expense, sales and distribution you will have to reduce. But that I am not considering. Broadly, you see, employees, suppose you see in accounts department, 5 people are working on billing the documents or processing the documents, processing the purchase documents, preparing the sales invoice. Is it not part of your production process? Because machinery, your documents are there, supplier documents are there. All those are used in the production process. They are indirectly used in the production process also. Are you getting me? Got it or not?
Yes, sir, got it.
Yes, sir.
Raw material will be, in what process raw material will come to the finished product. All those costs you will have to include. There may be nitty-gritties here. I am not going into detail. It will take a lot of time. If each individual item you look into, then broadly you see. Broadly it is like this. Raw material being converted to finished product. What are the costs involved? You put everything in COGS. Okay. So 10. Or in other expenses, what you will do? You see. You see
70% of 10 at 96.
how you will analyze these things. The raw material here, it is in the inventory stage. We are finding out average inventory. That means up to inventory stage we will have to consider. Tell
Yes,
me,
sir.
among those costs, these 3 costs, which cost will be after the period of inventory or before the period of inventory?
So selling and distribution will be
Yes, sir.
after the
Selling and
inventory.
distribution.
Selling and distribution will be after. These two will be before. Correct? So that's why we will not include selling and distribution. How much is the figure? Other expense figure is
70%, sir.
10896 multiplied by 70%. How much it is?
7627.
So 7627, sir, 0.2.
Okay. Average inventory not difficult to find out. So straight away 2021 plus 2020 divided by 2. Tell me the figures. Here all the figures are there. These figures together, sorry, up to this level. And these figures divided by 2. Tell me what is the figure?
So 3173.
Average. So
Yes,
quick,
sir.
you see, very good girl. Who is the girl? Let me see.
So me.
Who is this girl?
Sir, me, Aliva Mishra.
Sir, Aliva.
Aliva, okay. Aliva, good. Very good. So quickly you could calculate. COGS was how much? How much was the COGS? So 10896 multiplied by 70.
33207, sir.
Average
33207.
30?
33207.
207. So average inventory, how much Aliva told?
So
3,
3173.
7. How much is the ratio? 10 point something.
10.46.
46.
Now tell me, this ratio is good or bad? What I have told while we are discussing this thing, do you have an ideal ratio for this thing? Are you getting me?
Yes, sir. It is 10.465 times.
What I have told you, tell me.
Higher is
How
the
you should,
value, higher is the ratio.
how you should see
then
this
it is good.
ratio? I told
The
just
higher the
now.
better.
Higher the better, more the prettier. Last class we have discussed. So, you see how good companies perform in all aspects. They are good. 10.46. So 6, if you tell industry average, you can say it is a good ratio. 10.46 means quite good. What does it mean? That means with a lesser inventory, you can manage a higher production. True or not? This inventory is less, but you can manage a higher production with lesser inventory. Are you getting me? I have given you this example of copier paper. In a shop, you have got 10 pieces of copier paper. Another shop has got 50 pieces of copier paper as inventory. But they are, both of them are selling equal number of units, like 100 units. Which company is doing well? Lesser inventory or higher inventory?
Lesser inventory.
Lesser
Lesser
inventory.
inventory. Where ratio is higher? Where your inventory is less.
Lesser.
So that's why with lesser inventory, if you can manage higher production, it's good. So you see, a good company is an indication of a good company, 10.46. Got it? I shall proceed further.
Yes, sir.
All could get
Yes,
it. Let
sir.
me ask two students. Sarada Badiyar Singh.
Yes, sir,
Absent.
got it.
Can you explain me quickly?
Yes, sir. Inventory turnover ratio equal to cost of goods sold divided by average inventory. Here we found out cost of goods sold from this values like
Okay. Okay, I'm asking you a few questions, Sarada, you answer me. Where from you will get the cost? In statement of profit and loss or balance sheet? Sarada? Sarada? I think her network is bad. Or mine. Simran? Simran is
Yes,
absent.
sir. No, sir, I'm present, sir.
So much time to answer. Okay, Simran, tell me where from I will get the cost of goods sold figures? Statement of profit and loss or balance sheet?
Sir, profit and loss.
Profit and loss.
Statement of
You tell me which cost we have excluded from COGS in this statement? Which cost we have not considered? Not listening?
Sir, finance cost.
Okay. Which other cost? Good. Why finance cost we have not included?
So because it is cost of material consumed.
Okay. Tell what logic I told. Why I should not include the finance cost? Who can
anything
say?
that is not
Or it is
contributing to the
related to
cost.
operational efficiency.
So it is related
So
to
you see,
finance.
COGS is a concept which relates to operational efficiency. Financial cost, it relates to financial efficiency. That's why we are not considering. Okay. Which other cost, Simran? Simran,
Yes, sir.
which other cost? Not listening at all. Sambita?
Sir, operational cost.
No,
Sir,
no.
selling and distribution expenses are not included in this.
So some selling and distribution also we have not included. Why we have not included selling and distribution, Sambita?
Sir, in the production case, it is not using the cost is not involving in the production case. It is after inventory it is used as well.
Yes, good, good. That's like a good tell. Okay. After inventory using the cost, so don't use it. So COGS you got it. Average inventory is not difficult to find out straight from the balance sheet. 2 years figure average you have taken, and you found out 10.46. Okay. Sambit Kumar Sahu,
Yes, sir.
tell this ratio is good or bad. So much time? 10.46. Good or bad?
Sir, good, sir.
Why good? So much time?
Sir, it's better than the average, sir. The average was
Not,
6.
not average. The ideal one is 6, more than it is more than that. But that is, you see, the level of intermediate and graduate level. Tell me the logic. Why we tell that 10.46 is good? Okay, fine. Will you tell? Simple logic.
Lesser inventory.
Yes, correct. Lesser inventory. Through lesser inventory, you are managing higher COGS. Correct. Then only to get 10.46. Denominator is high. Sorry, numerator is high, denominator is less. So with lesser inventory, you are managing higher production. Naturally, it is good. Good. Got it, Sambit? Sorry, Sambit Kumar Sahu.
Yes, sir.
Sambit got it or not?
Yes, sir. Yes, sir.
Okay. Quickly find out the receivable turnover ratio. Let us see who does it fast. It is quite easy.
So is it 32.35?
11.28, sir. Sir, 11.28.
We'll calculate now. I think somebody who has told 30.
Yes, sir, I
is
told, sir.
correct.
32.36, sir.
Yes, sir.
He is correct. He is correct.
32.35, sir.
Tell me the figures. I'll write down because many people may not
Yes, sir.
have remembered the.
32.36.
Okay, tell me the formula we are writing.
Sir, total sales by
Average
Total sales by average
average
receivable.
debtors. Yes, sir.
Average
Sir,
receivable.
is it total sales or credit sales, sir?
No, it should be either credit. It should be ideally credit sales. When figures are not available, what we will do?
Total sale we will take as credit.
We'll take. Okay. So usually in most of the cases now for analysis purpose, suppose you are doing analysis of a company for investing, people don't go into so detail that finding out credit sales because when you compare in one company is total sales, in the other company also total sales, it is comparable. Are you getting me? Ideally it should be credit sales. You are correct. So tell me which figure you should take?
Sales
Thomas?
operational.
47028, sir.
470. No, it
4702.
is not 410. This 410 will
470.
not be taken. Why it will not be taken? We have discussed in the past day. These are not directly production revenue. We have discussed or not? Income from interest, income from dividend, income from.
So that is not, sir, operating income. That's
Yes, operating income. It is not good. So average receivable, how do we put? What are the figures?
1453.5, sir.
How do you tell me both the figures? Let me put it in detail.
So 1758 plus
1758 plus
1149.
1149
One at a time. 1758.
plus 1149.
Again, one at a time. 1758 plus
11.
11.
11.
1149.
Yes, sir.
1149 divided by 2. How much it is? 30? 2.36.
2.36.
Again you see, good or bad? It is outstanding. Why? Why outstanding? Because
So
usually companies, they generally, if you consider the whole industry, manufacturing, that, consumer durable, pharmaceutical, everything, textile, everything you consider, 4 is just to be an ideal ratio. Just imagine, it is 32.36, 8 times better. Naturally, in FMCG, usually it is lower, it is higher, but thing is that still it is much better than most of the this company, which companies? FMCG companies. Why I am telling you, you see, see the logic behind it. 32.36 means suppose we consider 1 year period. 365 days divided by 32
365.
point. Okay, 360 we put. Divided by 32.36. How much is the figure?
Sir, 11.12, sir.
Do you see here? 11.1 in 11.12 they are covering the customer
Debtors
pays
into
back
cash.
in the customer pays back in 11.12 days. Is it a small achievement?
No, sir, big.
You see, from your godown the stock goes, just think of Hindustan Unilever, goes to every corner of the country through distributors, wholesalers, retailers and then customers. And you see small shops around the country. And still you see the whole process is covered from and coming from one plant, say one plant from Bihar it is coming, it is being distributed in Kerala. So in 11 days you have got back the payment. This is an outstanding achievement. Getting? Getting or not?
Yes, sir.
Yes, sir.
Yes.
So next ratio is, I think the other ratio I need not discuss. You can calculate and interpret like this. Payable turnover ratio and asset turnover ratio. Let us do the asset turnover ratio. Payable is same, I am not doing it. Working capital also I leave. Asset turnover ratio, let us see. So, what is the formula?
Total income divided by total asset.
Average total assets.
So total income divided by total asset.
Average total assets.
Should I put total income or total sales?
It's total
Total
sales.
sales.
Total sales you pay. Because everything we are putting sales, so that's why total sales we put. Why? Average
Average asset.
assets. So total assets is this figure. Average assets is how much? How much is the asset?
47,000. Sorry. Triple
Tell me the individual
Sir,
figure.
4455. 4455. Oh, the
Tell me both the
individual.
figure. Tell me the first year
Answer
figure was
is
how much?
68757 plus 20153 divided by 2.
How much it is?
4455, sir.
So it is 47028 divided by 44.
4455, sir.
How much is the ratio? 1.05.
Yes, sir. 1.05 or 1.06.
Mahasweta Panda joining now. Leave it. Okay. So now you see, this ratio doesn't look very nice. So you may be asking, so you see how interpretation can lead to you several things. You can know about many things in the company. So when you found such a good company, everywhere ratios are so good. Why this ratio of your asset to turnover is so less, 1.05. It should be a little bit more because FMCG company, lot of assets is not used. Lesser asset they should manage. Why they are using so much of assets? You see a figure, you can understand it better. You see, here in 2021, what is the figure? 68757. In 20, this is figure 20 for 20, 2153. So tell me, it is a 75 years company. In 75 years, the figure was 2153. Immediately in 1 year, how it went up to 68,000? Getting it or not? An asset base of 20,153 is created in 75 years. In a single year, it went up to 68,757 in 1 year. That means What do you mean by it? There are certain exceptional items, or there is something, some book figures or book adjustments are there which is giving so high figure. Are you getting me?
Yes, sir. Is that real, sir?
It is real figures. So I have observed, I have not thoroughly investigated. Some goodwill figures have come here, maybe due to merger or some other thing. You see, sometimes book adjustments are done. 3-4 companies are they have all that figures are put together. Then figures will be different. So you see, you find out the reason behind it, why it is like this. In annual report it is written.
Sir,
Okay.
maybe consumption is more.
You see, no, you see this figure is changing.
In probate fund.
Plus, how it can change so high? 47,439, 8013. In 25 years, 75 years it reached 8013. 1 year it will be this much. Some book adjustments are there. It is there. I have seen it, but I have not inquired thoroughly. You try to investigate why this figure is going up so high immediately. Okay. Or putting the figures on my side maybe. One is a consolidated figure, one is a standalone figure. Sometimes while putting the figures I may be wrong. No, I don't think I am wrong because I have taken screenshot and put the figures. Okay? So you will have to investigate. Are you getting me? You see the ratio is indicating to so many things. When you found 1.05, you see the way I am telling you, I analyze like that only. 1.05 Hindustani Unilever, not possible. It should be better. So let us see the figures. One individual you see the figure, you see this kind of variation. That is, some book adjustments are done, something has been happened to the company. Who is the investor or the management? Management, they know it. Investors and the outsiders, the stakeholders should take note that, okay, why this figure has changed so high. Otherwise, you see, am I audible?
Sir.
Yes, sir.
So, otherwise, you see, what the investor will think. The company has outstanding result, outstanding asset base has increased in outstanding way. If you see in a graduate mindset, what you will tell? You will tell the company has outstanding performance over the years because asset base has gone up so high. But in reality, it is a book adjustment. Got it? Everybody awake? Minaki? Yes, Minaki? Where are you? Sandeep Kumar Panda?
Yes, sir.
Sandeep, could you get it?
Yes, sir.
Can you explain from the asset turnover ratio how I deduced about the company? Because I analyzed their figures. Yes. Sandeep, not listening.
Yes, sir. Yes, sir, I'm listening.
Tell.
Sir, actually, I'm facing some network issues, so
Okay, fine, no problem. You, Palo?
Yes, sir.
Well, did you understand what I am trying to explain?
Yes, sir. You explained about the asset turnover ratio.
Tell. I said, but you
The
tell what I said.
calculation is like total sales divided by average asset.
Good.
So we calculated
Figure.
this.
How much was the figure?
It was 1 point something, I guess, sir.
1.05. Okay, you are not writing down? Okay. I am providing the recording why we will write. Okay, 1.05. Then tell me, what we deduce from this 1.05? Who can answer? What we are deducing from this 1.05? Somebody?
Sir,
Who
it
can
is.
volunteers? Raise your
Sir,
hand. Tell. Tell.
so the ratio is not very good, and there might have been some book adjustments which have been done because of which The ratio is not very good. It could have been more, little more.
So the ratio, the company being a very good company, having so good performance in all aspects, should have a better ratio. That is our view. So we will now go in deep into the figures and find out what has gone wrong. So we found that there is a wide variation in your reserve and surplus. So you will have to again explore what kind of variation it may be. Are you getting me? Is it a book adjustment? Is it a consolidation? Or is it the treatment of a goodwill? What has happened? That you will have to see. Okay? Getting or not?
Yes, sir.
Yes?
Yes, sir.
Yes, sir.
Nobody is getting? Tell. 4, 5
Getting it.
should immediately tell,
Yes,
yes,
sir.
we got it.
Yes, sir.
Yes, sir. Yes, sir. Yes, sir.
It means also tell, sir, no. Then I will explain again. Okay? So we'll have to explore further. Are you getting me? Ratios, it looks so simple, but how powerful they are. They can tell many things about the company. So working capital turnover ratio, payable turnover ratio, you find out, easy to find out. Then we'll do cash conversion cycle. That we'll calculate now. The formulae are there. Why the students are joining so late? Okay. So formally we have written raw material inventory by raw material consumption multiplied by 360. So tell me the figures, I will write down. What is the raw material inventory? So first I am writing raw material, sorry. Raw material conversion period. What is the formula?
Raw material stock divided by raw material consumed into 360.
Raw material inventory by raw material consumed multiplied by 360. How much is the raw material inventory? We will take the figure of 2021 only. Why? Because we are calculating for that year. Tell. How much it is?
1314.
1314.
This is the raw material inventory.
Okay. What is the raw material consumption? Where you will find out the raw material consumption figure? Statement of profit and loss. How much is the figure? Quick.
53.
Five.
553.
Multiplied by 360. How much? How many days?
Twenty-one days.
21 days. Okay. Then is WIP conversion period. So WIP inventory divided by cost of production. So now you see cost of production, how we will find out? So here you see usually the difference between cost of production and cost of goods sold is the adjustment of inventory. Okay, adjustment of finished goods inventory. But you see, as we don't have all the figures separately, we can straightway take COGS also. Tell me what is the figure? WIP inventory is how? Are you getting me? My logic? The difference between cost of production and cost of goods sold.
Sold is 47028.
No, first understand the logic. Cost of production and cost of finished goods. Sorry, cost of goods sold has certain amount of difference. So that difference is the adjustment of finished goods. But here you see work in progress, finished goods and stock in trade all are given together. We cannot segregate. So we can comfortably, for our convenience, we can take COGS. How much is the figure? Tell. WIP inventory is how much?
432.
4 divided by cost of COGS is
25,508.
tell me multiplied by 360 how much is the conversion period?
7, sir.
7 days. Okay. Then tell me the next figure. What is the next figure? Inventory conversion period. It is finished goods inventory. Sorry, finished goods inventory conversion. Finished goods conversion period. So I put it. How much? What is the formula? Inventory finished goods.
Finished goods inventory divided by cost of sales into 360.
So here you see again same way. You see what is the difference between cost of sales and cost of goods, your cost of goods sold? Here you see usually the distribution expenses, packaging expenses you will put. Again we don't have separate figures, you take also again COGS. So how much is the inventory finished goods?
1607.
1607 divided by 23508 multiplied by 360. You see ideally it should be separate. When somebody is calculating for a company, they find out the figures separately. But we are not going to show complexity. You only remember that the difference is the distribution cost, the packaging cost, and labeling cost. You see, you put the labels and all those things will be included. That figure is not available, so just put it like this. How much is the figure?
25.
25. Sorry, this
Yes.
one is 2550. Is 25?
Yes.
Yes, sir.
Then you tell me the receivable turnover period.
23 days.
25.
Tell. Whatever, let us put.
3.
Now, next is
Cost.
receivable conversion period. Then you write the trade receivable divided by
Yes, sir. Into 360.
yes, into 360. How much it is? Sorry.
1758 divided by 47028 into 360.
47.
028.
How much it is?
Thirteen point four.
13.45.
13 days.
13.4575.
Okay. Now next is PDP, payment deferral period. So we write trade payable divided by COGS multiplied by 360. How much it is?
Double 802 divided by 25580.
How much?
8802.
Divided by
25580.
08, I think. How many days?
123.
124.2.
124.
124.2.
2.2.
Yes, sir.
Now, let us find out the cash conversion cycle. How much the raw material conversion period? Raw material conversion period plus WIP conversion period plus finished goods conversion period plus received conversion period minus PDP. How much the figure? Tell me quickly. RMCP.
21 plus 7 plus 25
One at a time. 21. WIPCP
plus 7
plus finished
25
goods conversion 25.
plus
Received
13
conversion period 13 minus 124.
125 sir, 24.9 equals
How much is the figure?
minus 62.
Minus 62. Correct. Do you see? The
Sorry
company
sir,
is fully...
I've done something wrong. Sorry sir.
So minus 59. Minus 61. 61 sir, 61.
Do you see? What do you conclude from these figures? Tell. Quick. But by this time we have done lot of analysis. You would have understood how to interpret it. What do you conclude?
Sir is better.
Lesser is better too. But when you go to individual figures, what do you conclude from those figures? Where your money is blocked? Money is in those 5 conversion periods, where your money is blocked?
PDP. Yes sir.
PDP is blocked. Money is blocked in those stages. So we can say these are diseconomies. That means money is blocked. Where is the economies? This one. That means you are using others' money to manage your business. So minus 61 means what does it tell? The company is fully managing its business from others money and still getting advantage. Bhaskar getting?
Yes, sir. Yes, sir. I'm
But
getting.
recollect, I have told you when we analyzing the figures, I told that if your payable you can manage in others' money, why not use it? Unilever, is it not doing like that? Getting yearly
Yes,
payment
sir.
from the customers, all those conversion period is reducing so that its money is not involved. But payable period is so high, that means they are managing others' money. Are you getting me? But
Sir,
here
can you
the
please
method
repeat the
doesn't.
final conclusion again, sir? What does the minus
What I am
61
telling you, your money is blocked in RMCP, WIPCP, FGCP and SCP. But when it is PDP, when it comes to the case of PDP, the company is using the supplier's money to manage its business. So finally we see supplier's money is used more than the money blocked because 61 minus. Again you see, when you find figures like that, again you will have to go to individual figures. It's 8802, how far it is realistic? Is it a one-time expense or a one-time payable? Is it for machineries? Many things will come to picture. Are you getting? But generally I am telling the interpretation. Because simply believing that 61 is the minus 61 is the cash conversion cycle doesn't make sense. So we'll have to again reverse calculate and see the figures. What is the constituent of 8802? Is it proper or is it less or more? Is it relating to your machinery liabilities also? So that way again you will have to analyze. Are you getting me?
Yes, sir.
So,
What I am trying to impress upon you, that the basic concepts or logic behind all those things is supported by certain logic, is supported by certain arguments. And if your arguments are logical, the company will perform well. But again, figures we are getting is not sacred, you cannot tell it is foolproof. Because individually if you see the figures, maybe something different will come to picture. You don't know. As I told, total assets, figure varying so much, again you have to analyze. 8802, so high payable. Does it involve some other things, other payables? Let us see. If it involves to assets, you will have to again remove it, figure maybe less. Could you get me? No, yes, again, silent.
Yes,
yes,
sir.
sir. Yes, sir.
Yes.
So what we are approaching here, we are trying to develop a mindset. How do you progress that? How do you approach the figures? How do you calculate the ratio? How you will take the figures? When your figures will be justifiable? If figures are coming like this, can you question it? If you question it, where you will question? And finally you find out what is the right thing. And then conclude the performance of the company. So overall you can find most of the cases the company is a good company. All those periods, conversion periods are quite low. Correct? Ratios are low, conversion periods are low. Only assets turnover ratio was high, again was not satisfactory, then again we found out that some exceptional items or one-time expenses, one-time figures have come to the balance sheet. That you'll have to analyze further. Here again, payable figure you may question also. Can it be so low, so high? Is it done?
Yes, sir.
Yes, sir.
We can
Yes,
close
sir.
the chapter of working capital here.
Yes, sir.
I have got three things to ask you in this area. I will maybe asking you the interpretation of the ratios. I will give you 2-3 companies and then I will tell you interpret how. Remember, calculations is not your job. Interpretation is your job. Calculation will be done by the clerical people. People who have just passed out matriculate, graduate, those people will be doing the calculation. Interpretation is your job. Finding out the reality, analyzing, comparing with other company, comparing with other years. You getting me? Comparing with industry average, comparing with benchmarks, comparing, finding out a trend. All those things are your job, and then concluding how the company is doing. Okay? So, three kinds of questions you don't bother with too much. If you are approaching it in the proper way, I will give you marks. For those marks you don't, and I know you people will be copying from each other. That doesn't make any difference to you and me also. So, try to understand the basic behind it. How do you approach the subject? How do you calculate the ratio? What kind of conclusion you can do? You are an investment analysis. 4-5 companies balance sheets are giving you. How you can analyze them in terms of working capital management. So we discussed first working capital policy we discussed. There I may give you a question. Ratios I may give you a question. Calculation of the cash conversion cycle I will give you a question. And 50% of the answers will be interpretation. The way you approach, the way you see the things, the way you interpret, that will be important. Done. I should have started capital budgeting today, but no time, unfortunately. Let us close. Do you find finance too boring?
No, sir.
No, sir.
So people answer, that means except 2 students, it is boring for everybody. Fine. Okay, let me take that one as quickly.
Sir, we will get the same type of question in the exam session.
Again, I told don't bother about them. 3 kinds of questions
Sir,
I may ask.
in the end, sir,
Remember,
how many questions?
whatever I am teaching, I will never ask in the exam. Be sure about it. Because I want to test your mind how you have understood. Not what we have learnt in the class, straight a figure wise figure, I put it like this, calculate, do it, not like that. Okay. We just
So
if
in
one or
the
two method.
so in the end, how many questions will be from your section or from the KK Roy section, sir?
In his section it will also come, but preferably the section B will be from my section. Okay.
Okay, so all the long question will be from your section only.
Preferably I told. So I am
Yes, okay,
keeping
sir.
the options open. But more questions, about 3 questions are there, 2 will be from my section at least. Okay.
Okay, sir.
Unhappy?
No,
Happy
sir,
sir.
I'm happy for that.
Right. Okay, Avinash Mahapatra,
Present sir.
Avinash Patnaik,
Present sir.
Aditi,
Present, sir.
Aditya, Aishwarya,
Present, sir.
Aliva,
Present, sir.
Alok.
Present sir.
Alok, what is happening? Silent throughout, not a single word.
Yes sir. No sir, I'm doing.
You are doing, but I can't know whether you are understanding or not because every student is important for me. Not like people who are participating only. Okay. Anuradha,
Present, sir.
what about you, Anuradha? Coming in, going out in between. No answer.
Sorry,
Aritra,
sir. Present,
Aritra,
sir. Present, sir.
Aritra, sorry, Aritra. Why so difficult name you are keeping? I am ordering it as Aritra. Aritra, what about you?
Sir, I participate, so I raised my hand today.
Okay,
Previous
I
class.
didn't ask. Okay, fine, good. Arpan Mohanty, Arpan Narayan Bahidar, Ashish Kumar Paikrai,
Present, sir.
Abhik Chatterjee,
Yes, sir.
Bhaskar Kumar,
Yes, sir.
Sandita Mishra,
Present, sir.
Chinmay Mohanty, Devapam Malik,
Present sir.
Deep Sikha,
Present, sir.
Gautami Srivastav,
Present, sir.
Ittishri Prushti,
Present, sir.
Mahashweta.
Present, sir.
Mahashweta, you joined half the class. After we
No,
have
sir.
finished
Actually,
after that.
I got disconnected, so I rejoined at 5. I was there.
Nirbhik,
Hello.
Yes, sir.
Pratyusha,
Present, sir.
Hello.
Pratyush Kumar, Rahul,
Yes, sir.
Rajeshwari, Rishabh,
Present, sir.
Minaki, Sadeep, Sambit Kumar Sahu,
Present sir.
Sambita,
Present, sir.
Santanu,
Yes, sir.
Simran,
Present, sir.
Shraddha, Sarada,
Present, sir.
Shivam, Shriya,
Present, sir.
Shriya Shruti, Sneha,
Present, sir.
Soham,
Present sir.
Samajit,
Yes, sir.
Subrajit, Subhajit,
Present sir.
Shubham,
Present sir.
Sunit,
Present, sir.
Tiny.
Present, sir.
Is it Tiny or Tiny?
Tini.
Tiny, okay. Yash,
Present sir.
Aditya,
Present sir.
Abhinav.
Present sir.
Abhinav, what is happening? Never speaking. Kumar Aditya,
Present, sir.
Shivani,